Hey, it's Tom here and welcome back to the channel. Now, in this video, I want to talk about cash. It's a topic that we touched on actually yesterday over on Punch Card Investing. Basically talking through some of our own thoughts on how we each think about having some sort of allocation towards cash in our own portfolios. Now, cash clearly is not a particularly good long-term investment, but it does provide optionality. And when we do have wild fluctuations in markets, it really does provide a good opportunity for us to deploy a lot of money at potentially much higher rates of return than if we were to deploy it in more normal, kind of less fearful times in the stock market. So I think it's a good time for me to personally revisit my sort of cash strategy and how I think about how much cash to keep in the portfolio. So I do hope you enjoyed the video. Now, before we get into that, we do have a sponsor for today's video, and today's sponsor is Sharesight. Now, Sharesight is actually the tool that I personally use to track my portfolio. Now, I, as a New Zealander, have holdings in actually a couple of different countries. So as it stands at the moment, I own both New Zealand shares and US shares. And there's a few things that can make, firstly, tracking the returns of my portfolio quite tricky, and also can make tax time kind of tricky. So I have a couple of different brokers. I use both Hatch and ASB Securities, and I have those different holdings obviously denominated in either New Zealand dollars or US dollars. So Sharesight is the tool that I use to track my portfolio and get a good handle on the real returns, whether that's from capital gains or dividends or changes in exchange rates and currency fluctuations. So it's a really useful tool, and also when it comes to tax time, it's very, very simple for me to just pull reports out of Sharesight to give to my accountant to then help me make my life a whole lot easier when it comes to tax time. Sharesight also actually has links with several of the brokers. So in my case, with ASB Securities and Hatch, I can easily import all of my trades into Sharesight to keep track of my portfolio in the first place. So there's not too much kind of manual entry of trades and that sort of stuff, which is really handy and a nice time saver as well. So if you're interested in checking out Sharesight, you will need to go to the link sharesight.com/investingwithtom. There is a free version available, but if you use that link and then go on to sign up to one of the paid versions of Sharesight, which has far better tax reporting features and so on, that link will actually get you 4 months free off of an annual subscription. Okay, so cash. Now let's, I think, do a bit of a quick refresher on some of the basics when it comes to having cash in the portfolio and some of the potential pros and cons, and then towards the second half of the video, I'll get into how I'm approaching holding cash personally, and also some of the exceptions that I think you might want to make to these rules, particularly if you're a smaller investor or you're just getting started in the stock market maybe in the last couple of years. Now, cash clearly is not a good long-term investment. If you're wanting to grow your portfolio at a reasonable rate, compounded over a long period of time, cash is not going to be the best option for your money, most likely. The Federal Reserve in the US and many of the sort of central banks globally are targeting 2% inflation every single year. So if you have cash just sitting in a savings account, let's just assume it's earning 0% interest for simplicity. If you have 2% inflation, then the purchasing power of those dollars is going to actually go down by 2% per year, which is the exact reverse of what we want to achieve as long-term investors. We want to grow our purchasing power of our dollars over time. So cash clearly is not a good option for a long-term investment, but like I say, it does offer plenty of optionality with short-term fluctuations, and for that reason, I think it can be a really useful segment of the portfolio. Now, if you're someone who is a professional investor or you invest in ETFs or indexes, you will often hear this term thrown around called cash drag. Now, cash drag is simply the idea of if you have cash sitting on the sidelines that is not invested, then you're capturing less gains than you potentially could if you had everything invested. Over a long period of time, that cash can be a drag on your returns. So if you have a small percentage of the portfolio earning 0% or next to 0% with current interest rates, and you have the rest of your portfolio invested in an index fund, for example, earning 8 or 10% a year, then your compounded return over an investment lifetime is going to be pulled down by having some cash in the portfolio. So I'll put up some example screenshots here. Let's just say, for argument's sake, that you're starting from zero in your investments today and you invest $10,000 $10 per year, and you just invest that in some sort of index fund which earns 10% a year. Now, if you go through and do that and you hold no cash at any point in time, then you will capture the full 10% a year, and you'll end up with a nice compounded return at the end of that investment journey. Now, let's say, for argument's sake, that instead of having everything fully invested, you like to have this little cash cushion, just in case of emergencies or whatever it might be. And throughout that entire investment lifetime, you have, say, 15% of the portfolio in cash, earning, for argument's sake, let's just call it 0. Now, you may be able to get 1 or 2% or whatever, but let's just call it 0 for simplicity. So if you have 15% of the portfolio in cash earning nothing, and you only have 85% now invested, then your compounded return on that overall pile of capital is actually going to be pulled from 10% down to 8.5%. And you'll see that that does have a significant reduction in the number of dollars that you end up with at the end. And really, the longer period of time that you stretch that investment horizon out for, the more significant that cash drag is going to be in terms of reducing your overall results. So clearly, cash is not a good option if you're looking to be an index investor over the long period of time. You basically want to have as little cash as possible if that is your strategy. And for that reason, you'll often see many professional investors not have a whole lot of cash around either, because of this sort of cash drag concept. They expect the market on average to go up. They think that it will go up more often than it goes down, and therefore it makes sense to have a very small amount of cash or even zero cash for as much time as possible. Now, when you have a strategy that is not index or ETF focused, this is where I think the equation can change quite substantially. So if you're someone like me or many of the investors that I personally follow, like Guy Spear or Mohnish Pabrai or Warren Buffett or Charlie Munger or Lee Liu or any of these big value investors, famous value investors, I think that you'll find that a lot of these investors tend to hold a small amount of cash quite a bit of the time, and even a substantial amount of cash from time to time. And the reason for that is optionality and being able to take advantage of big fluctuations in markets. And if we relate that back to some of my examples earlier with the compound interest screenshots I put up, which show you the effect of cash drag, I think that cash drag argument has one fundamental and very, very important flaw in that argument. And that flaw is basically, the fundamental assumption with cash drag in that situation is that every dollar that you invest is going to earn a similar rate of return, so about 10% a year in the example that I used. Now, if you're someone with a strong value investment framework, as an example, that is probably not going to be the case. You could argue fairly easily that if there's a situation where Warren Buffett, for example, is putting a huge amount of cash to work, it's likely that he's thinking that he can earn a much higher rate of return than 10% a year or whatever his particular hurdle rate is. And this is where the advantage of having cash really shines. So if we go back to, say, March 2020 last year, if you had a high proportion of cash at that time and you'd deployed a lot of it through that crash as stocks on your watch list got to margin of safety prices and so on, all of a sudden the dollars that you're able to deploy through that crisis and through that period of time where prices are really depressed, the return that you're going to earn on those dollars can be substantially higher than the 10% or whatever your hurdle rate is. And it means that if you start to look over a long period of time on a compounded basis for the overall portfolio, suddenly if you have some money invested at, call it 10% a year, and if you have some money getting invested at 0 from time to time, but at other times it gets invested at, say, 40% a year because you're able to take advantage of some of these extreme mispricings in markets, then the compounded return for your overall portfolio can be really, really good. And although it might be painful in the short term perhaps to hold on to some cash, it can be extremely beneficial in the long term. So that now brings me back to my own personal investment framework when it comes to holding cash in the portfolio. And basically, I have cloned the shameless cloner, Mohnish Pabrai, and I've really taken his approach when it comes to managing cash. Now, Pabrai is one of the first people that I came across that really has some actual quantitative kind of approaches to trying to figure out how much cash to hold in the portfolio. And I'm really unsure if this is the way that he still thinks about it. He's mentioned this in some older interviews, and I know he has kind of had a change in philosophy when it comes to his investment strategy in the last year or so, but nonetheless, I still find the strategy particularly helpful for my own investing. So here it basically is. Now, let's assume that we start out with no money invested. So we have the entire portfolio just sitting in cash, and we're looking to deploy that at certain rates of return that we view as attractive. Now, the first kind of threshold at which Mohnish Pabrai will deploy capital into investments is when he thinks that he can potentially get a double in the next, say, 3 to 5 years. Now, if he can get a double in the next 3 to 5 years, he will actually invest up to 75% of the portfolio. So he's getting fairly well invested if he can find, a basket of businesses that he thinks have an attractive return, a double in 3 to 5 years. So, the classic old school Pabrai where he's looking to double his money every 3 years in order to compound at 26% a year. And he's even had the, number plate on his car, compound 26 and so on. That's kind of where that came from. So that is the first hurdle rate for Pabrai. And basically, as you continue to go through these next couple of thresholds, you'll find that basically the hurdle rate or the required rate of return starts to get higher and higher. And these final bits of money that you would put into stocks are what Pabrai at the time was describing as very expensive capital. So in other words, in order for him to deploy that into the markets, he had to earn a very high rate of return. So this first threshold you have is 75% into doubles. You then have 10% into the next 10% into triples, which takes it up to 85% invested. The next 10% into 4x's, and then the final 5% into 5x's. So in order to get fully invested, you have to have some opportunities, at least in the portfolio, that you think have the chance to do a 5x return in the next 3 to 5 years. And I just want to sort of give a couple of kind of footnotes or thoughts also around framing that philosophy from Pabrai. Now, one of the comments I got on a previous video when I first shared this philosophy from Pabrai was that, Mohnish Pabrai is taking more and more risk, with the every incremental dollar that he invests into the stock market. And I think it's actually the entire reverse. So if you think about Pabrai's initial framework of trying to buy $1 for 50 cents, that means if he can find enough 50-cent dollars, he'll get up to that 75% threshold of 75%, being invested in doubles. And the threshold basically gets more and more extreme. So in order to get the last 5% of the portfolio invested, where he's looking for 5x's, he's looking for things that are trading at like an 80% margin of safety, assets that he can buy for 20 cents on the dollar. And anytime that you're buying assets at a really big discount to intrinsic value, in fact, that's less risk that you're taking, and you have to take lower risk and get a higher return, and in Pabrai's mind at least, to justify, giving away that cash. Because like we talked about earlier in the video, cash can be very, very useful when markets fluctuate wildly and you get opportunities to put that to work. So in order to give away that optionality, you really have to have something that is extremely attractive and where you think the chances of losing money over the long term are very, very muted. Now, there's one thing I want to mention here just to wrap this video up, which I think is particularly important to note for smaller investors. And this is actually a mistake that I think I personally made in my first few years investing as well. And as a general rule, I have tended probably to keep too much cash around. I probably haven't been as invested as I should have. And one of the reasons why I say that is because when I was first starting out and I was, literally starting from almost zero, and I was, earning money in my day job and then putting that money into investments. I was watching the likes of Phil Town and Mohnish Pabrai and all these people talk about the importance of cash, in order to have optionality with buying stocks when markets fluctuate and so on. And one of the things that I did is, I might have had a $5,000 or $10,000 portfolio at the time, and I'd have 30% of it in cash. And, although that might fit the framework of which percentage allocations to have and so on, it really wasn't the way I should have been approaching it. At a certain point, absolute size does matter, and in that situation, when I have maybe a $5,000 or $10,000 portfolio, my savings over a relatively short space of time are probably going to be equivalent to my current portfolio size. So if I'm fully invested with smaller amounts of money, that's that's I think fine. And if you can get more cash into the portfolio just from your everyday savings, and those everyday savings are going to be a fairly sizable percentage of your portfolio, I think you can probably afford to be more fully invested, and there's not as much of a need to keep cash around with those smaller numbers. But certainly as the portfolio grows, and as say your annual savings as an example become a smaller and smaller percentage of your overall portfolio size, that's a situation where I think these frameworks from Pabrai work really, really well. So that's it for me for this video. I do hope you enjoyed it. If you did, please hit like and hit subscribe. If you're interested in the Sharesight offer, you'll need to go to the link here, sharesight.com/investingwithtom. Like I say, there is a free version available, but that will get you 4 months free off of an annual subscription if you're interested in that as well. But that's it for me, and I will see you in the next one. Cheers.